So, what's the difference between an S-Corp and an LLC? Well, first off, both of them are actually LLCs. When we refer to an LLC here, we're talking about an LLC taxed as a sole proprietor. We'll just call it an LLC. And then when we talk about an S-Corp, we're actually referencing an LLC taxed as an S-Corporation. Both LLCs and S-Corps provide business owners with a couple of things. Legal protection so that there's a corporate veil between the company's assets and your personal assets. They provide some operational advantages like partnerships and the ability to collaborate with others. And they both serve as pass-through entities for taxes, which means the profits and losses will flow through to the business owner. So let's get a little more specific here. For both an LLC and an S-Corp, you're going to be figuring out your tax on your net profits. Now, net profit is what's left over after you subtract all your deductions and write-offs from your business's gross income. Now, in an LLC, your entire net profit will be subject to what's called self-employment tax. Remember when you were an employee at another company and your paycheck had that little FICA or Medicare deduction? Well, when you have an employer and an employee relationship, your employer would have paid half the Social Security limit and Medicare tax, while the employee paid the other half. Now that you're self-employed, you'll get to pay the tax of 15.3% on all net earnings up to the Social Security limit, which changes each year, but is at $118,500 for 2015. After you hit the Social Security limit, all your earnings above that, you'll owe Medicare taxes, which is 2.8%. Then, after you pay your self-employment tax, you'll be subject to state and federal income tax. This is simplifying it a bit, but essentially you'll be paying an increasingly higher or marginal tax rate on your earnings. The more you earn, the higher your tax rate. So with an LLC, you'll pay 15.3% self-employment tax on all of your net profits. Then you'll pay state and federal income taxes on your personal tax return. Let's look at a quick scenario focusing just on the self-employment taxes for a fictitious LLC taxed as a sole proprietor. Here, if you had taken in total revenue of whatever, then after your deductions and expenses, you had a net profit of $100,000. Your self-employment tax bill would come out to $15,300. So we've got $100,000 in net profit and $15,300 in self-employment taxes. Breaking that down a little bit, that's a monthly bill of $1,275 just for your self-employment taxes. Now, after you've done your self-employment taxes, you'll still owe state and federal income taxes, which if you were single and had, let's say, $85,000 in taxable income, just your federal income tax bill would be about $17,325 on top of your self-employment taxes. That's not even factoring in your state income tax, property taxes, or anything else you pay. That $17,000 in federal income tax is just for a single person paying on $85,000 in income. So this puts your total tax bill, excluding fees, sales taxes, property taxes, state income taxes, or other dues, the total tax bill at a conservative $33,000 a year. That means you're taking home $8,300 a month and writing a check to the government for $2,750 a month, just for self-employment taxes and federal income taxes. If that doesn't get your heart racing a little bit, I'm not sure what will. So the question is, what can we do about this conundrum? Well, the most popular strategy employed is incorporating to an S-Corp. With an S-Corp, you'll incorporate and become an employee of your corporation. Then you'll take two forms of income. The first part of your income is that you'll pay yourself a salary. And the second part of your income is what's called a distribution or a dividend. So we're going to split up the income into these two parts, the salary and then the distribution. What you'll see in a minute is that the salary is subject to the 15.3% self-employment tax, while the distribution is not. So you're paying 15.3% on your salary, but not on your distribution. Because the distribution income isn't subject to that 15.3% tax, The temptation can be to falsely shift all your income over to the distribution and not take a reasonable wage, which is why the first part of your income, or that salary or wage or payroll, must be reasonable according to the IRS. There are multiple factors that dictate what kind of a salary you need to pay yourself. The salary needs to be reasonable for your experience, comparable salaries, economic conditions, and a bunch of other factors. This is super important. You must take a bona fide, reasonable salary. So now let's take a look at a fictitious S-Corp example. Now, looking at the same $100,000 of net profit, you'll pay yourself, for this illustration, a $60,000 salary. Then you would take out $40,000 in distributions. This is just an example. The tax benefit is that the salary is subject to that 15.3% SE tax, but the distributions are not subject to the SE tax. This means that $40,000 in distributions aren't subject to a 15.3% tax, putting your total self-employment tax due down from $15,300 when you were an LLC to $9,180 as an S-Corp. That's a 40% decrease. Rather than paying $1,275 a month in SE taxes as an LLC, you'll be paying $765 a month as an S-Corp. That means you've essentially freed up $510 in monthly cash flow in this scenario. In a scenario like that, $510 a month can easily help you save for retirement, pay off your mortgage early, hire some help, reinvest into your business, advertise, or invest in real estate sooner. Now, if you've already become an LLC and you like the idea of becoming an S-Corp, you have to file for an S election in order to become an S-Corp before March 15th. That's a whole month before April 15th when your taxes are due, or you'll have to wait till the next year. Strategies that utilize an S-Corp can give you tools to help mitigate your taxes, but these strategies should be handled by a competent CPA or a tax professional. Here at Nuance Financial, we specialize in helping small businesses from across the country implement these strategies as part of a long-term tax plan. So check out the description below and go to nuancefinancial.com. We'd love to connect with you and provide a free consultation.